5 years ago, I made the biggest financial mistake in my life. I lost millions of future dollars because my ego was intertwined with my beliefs, and I was unable to step out and see the full picture. I thought I was doing everything right. I was a West Point graduate, I was an Army officer, and I was making multiple six figures with my project management job after I got out of active duty. And ever since I was 17 years old, I would save between 40 and 70% of my income per year. My previous strategy was dollar cost averaging the S&P 500. I took my advice from my different mentors, and I maxed out my different government accounts, but I was over allocated inside of the market. And this isn't a hit on the general market as a whole. I'm a big believer in low cost index funds, but I was over allocated in the market and I did not see the full picture of general wealth building. I was approached about 5 years ago on how to use insurance as a tool to compound my generational growth, but I immediately wrote it off as a scam. I saw all forms of insurance as a scam and I was unable to break through my own beliefs. But eventually I had to question who I was taking financial advice from. I was taking financial advice from people that were, granted they were at the president CEO level, but they were all working 100+ hour weeks and not in the position that I wanted to be at. Nor were they progressing at the rate that I wanted to go at either. Meanwhile, the person that approached me had built multiple 7 to 8 figure businesses, and I was looking at him, telling him his method is a scam. That makes no sense. So I had to really question my beliefs. This process really started to unlock something for me. I prided myself on my financial education before, but I knew something had to change and I wasn't doing everything right. That ignited an absolute learning passion. Very rarely do I commit myself fully to something, but I committed myself fully to understanding this concept and how to apply it inside of my life. So I started reading a lot of books. I got into a lot of different research. And at the end, I realized that a lot of my internal network was already applying this concept that we're going to talk about. But what's tricky here is there's so much going on in the world of insurance. There's different types of insurance, and this ties into why this concept is so convoluted. So we see here, we have a lot of different types of insurance. We have health, life, auto, but this is all tied under the general term of insurance. And then when we're talking life insurance specifically, there's a whole lot of different types and different designs going on here too. So you have term versus permanent, and then under permanent insurance, which is where these specific whole life policies lie, there's a lot going on inside the permanent umbrella too. We have whole life, IUL, VUL, and much, much more. This adds to the convoluted nature of insurance as a whole. In this video, I'm going to break down and cut through some of those confusing points and lay out some things that I wish I would have known earlier before I got into this process. It's important to note here that there is a time and place for almost all products, but the right product for you is going to be determined on your risk profile and what you're trying to do and when. Especially in this industry, we get so tied to our beliefs. It's almost like politics. People get trapped in their own dogma and they're unable to have a conversation with someone because they lie on different ends of the spectrum. But just get super clear on what you are trying to do and when you are trying to get there, and you'll gain a lot more clarity on how to use these tools effectively. When diving into insurance, it's a good starting point to talk about duration. When we're talking duration, it's in the bucket of life insurance. There's really two main categories to break down. We have term and then we have permanent. With term insurance, we have regular term and then convertible. Regular term is going to cover you for a specific amount of time and it's going to pay that death benefit if you die within that specific bracket of time. Level term is going to cover you for a specific amount of time. It could be 10 years, it could be 20 years, but the rates do not change. You could also have annual renewable term, but those rates are going to increase each year. Again, with this term insurance, if you die within that specific bracket of time, you'll be paid that death benefit. Note here that a lot of term policies don't usually pay out. This is more of just an insurance that gives you a permission slip to spend, as your legacy and family will be covered with the term insurance. And then when we're talking convertible, all convertible term is, it's term insurance that you can convert into permanent insurance as time goes on. Regular term is going to be cheaper than convertible, but it's still the same concept. If you die within that bracket of time, you'll be paid your death benefit. The next bucket is permanent insurance. So there's a lot going on here, but the two main popular products that you'll see is whole life and then IULs. IUL stands for Index Universal Life. With whole life, you'll have level premiums, so you'll be paying the same amount of premium each year, and it's backed by stable investments. So if you rip open the hood on what's going on under whole life, the insurance company is investing your premiums into stable, safe investments like bonds. With IULs, you'll have a flexible premium, but if you look at the underlying investment, it's going to be tied to the market, and your cash value would be subject to change based on a cap and floor dictated by the market. So the comparison here is kind of like renting versus owning when we're talking term and permanent insurance. Term insurance is going to be cheaper, but you're going to have no ownership benefits inside of the policy. But when we're talking about permanent insurance, you'll have access to a cash value, which is essentially like equity inside of a house. So you're going to pay premiums in, aka your mortgage, and then you're going to have equity, aka cash value, that you could do different things with, i.e. leverage into cash flowing assets. The next concept I want to talk about is ownership. A lot of people want to use these policies as a bank to get into different cash flowing assets, and dividends are critical to make that operation true. We call dividends in the insurance world, but they're actually a return on premium. Those dividends get recycled into the policy and grow tax-free and sheltered inside of your whole life policy. When we're talking companies here, there's really two main categories that we need to be concerned with. The first one is stock and the next is mutual. So stock is AKA not participating and no dividends will be received. Also, you're not going to be an owner inside that company. And when we're talking companies for infinite banking, we're going to want access to that dividend. So stock is not going to be as beneficial when we're applying this specific concept. Next, we have mutual, AKA participating, and that will give you access to that return on premium, that dividend that will be reinvested into your policy tax-free that you could use as leverage into different cash flowing assets. And also with mutual companies, you'll be a co-owner in that company. And this just adds to the confusion that we talked about before. You could start to understand the convoluted nature to these products. Yes, if someone came to me with a stock company and it was using a stock company policy for infinite banking, then no, that wouldn't be a good design. That wouldn't be a good idea because you need those dividends to be recycled into your policy to act as a bank. So this is just one of the many layers that you need to sift through when coming up with a specific plan that's meant for you. The next topic to talk about is specific life insurance companies to work with. There is definitely a hierarchy going on here, and not all companies are created equally. Here are some stats and characteristics that you should be looking at when picking your provider. The first is going to be mutually owned and participate. We talked about this before with the mutual versus participating company. You're going to want access to that dividend, so you're going to want a mutually owned company. The next concept is being infinite banking friendly. There have been some companies that have shifted from mutual to stock before, so finding a company that is aligned with infinite banking will set you up for success. Next is history. So life insurance companies have been around longer than banks, and you're going to want to find a company that's around 100 years old or later. And all that does here is just giving you a track record for how this company performs. Next is the Comdex rating. So this is essentially like a grading scale that life insurance companies use. A Comdex rating of around 90% and higher is going to be very well suited, and you'll have no issues going with that company. My personal picks here are Lafayette and Penn Mutual. They're very infinite banking friendly. They've been around a long time. They have great Comdex scores, and their backend support is very easy to work with. There's some other great companies out there too. I'll list those below, but just be cognizant that some of those companies will have direct recognition and not non-direct recognition. We talked about these differences before in other videos, but they'll compensate for that direct recognition with typically a larger dividend. Some other great companies are New York Life, Mass Mutual, Guardian, and One America. The next concept that I want to talk about is efficiency, and this is arguably the most important topic here. We broke down this concept before in other videos. I'll link those in the description, but efficiency essentially means how much capital you get access to right away. So if I contributed 100K and I had 100K available in my cash value, that would be 100% efficiency. What's normal and solid in the infinite banking world is around a 70 to 80+% efficiency rating. And all that means is you'll have more liquidity to jump into cash flowing assets quicker, which is critical when talking about applying these policies to build generational growth in the most efficient way possible. And it's very important to note here, with normal whole life insurance, policies are going to have a 0% efficiency rating for the first 1 to 5 years. And this just adds to confusion like we talked about before. Again, if someone came to me with a whole life policy design that had a low efficiency rating, and we're using that policy to compound generational growth in the fastest way possible, then yes, I would not use that policy for that specific reason. The whole point of setting up these policies is to have a large amount of cash value liquid ready to go year one, so you could take that cash value and leverage it into cash flowing assets to compound your growth quicker. But if I have no liquidity in my first 1 to 5 years, then no, that's not a good design for what I'm trying to do, and I wouldn't go with a product like that. And that's not to say that a straight protection policy is bad. It just doesn't suit what I'm trying to do and when, but you could see how this adds to the conflicted nature of insurance as a whole. The next concept that I want to talk about is commissions. So important to note here, you should not be paying your insurance agent anything extra on top of the service he's providing. Your insurance agent is paid by the life insurance company. Yes, insurance agents do gain a commission, but that commission is coming from the life insurance company. When talking commissions, we really got to understand the two main components of premiums, which are the base and then the PUA, which is paid up additions. Those are just little bits of extra insurance. Here's the critical information that you need to know. The commission is going to be mostly based off the base value inside the premium. A higher PUA is going to yield more cash value, and that's what we want for the infinite banking process. Infinite banking policies are typically going to have around a 60+% PUA, so the base is going to be very low. Infinite banking agents are typically going to make around 100 to 600% less compared if they were selling you a straight protection policy. If you got a straight protection policy, that policy would have a much higher base premium. And again, the base premium is what drives the commission rate inside the policy. Yes, you do get a commission on the PUA, but that is significantly less than the commission that you make on the base. And that's where things could get very convoluted. People could promise some of the benefits of privatized banking, but they will sell you a protection policy and gain way more commission. To be very clear, let's run through some commission math so you could get an idea of how much money your insurance agent will be making when we're talking your policy. We're going through a real life example here. Let's say that we have a 12K annual premium and we have a 40% base and a 60% PUA split. Like we talked about before, the majority of the commission is going to be based off the base. So if we have a 40% base policy, we take 40% base times our 12K premium, which comes out to around $4,800. $4,800. And then we're going to apply the actual commission rate for that $4,800. Commission rates are going to be on a sliding scale. They're going to go from about 55% to 100+%, depending on how much money you're bringing into the insurance company. For this example, let's say we have a new agent and his commission rate is around 600%. That means the total take-home money before taxes is going to be around $2,880. And note here, you do make commission off that PUA, but it's going to be significantly less than the base premium commission. So note here that commission rates are going to vary. And this again adds to the very convoluted and murky waters that exist inside the insurance industry. So you have to be very careful when building the policy that's right for you. A lot of agents will promise value, but the specific product that they give you is not in line with what you're trying to do and when. They can modify the structure and modify the product so they make a higher commission. That is why it is absolutely critical that you know what you're trying to do and when you're trying to get there. That way you can make the most informed decision. So if an insurance agent is trying to sell you on something different, you can catch him in his tracks. On the topic of commission and these convoluted waters, I really want to highlight something that's very common in the industry, and that is the debate between whole life and IUL. It's important to note here, when we're talking about using these policies for compounding generational growth in a safe manner, we must understand the difference between these two products so we can protect ourselves. And the right product for you is going to be based on your risk profile and what you're trying to do and when. Neither product is terrible, but you need to be cognizant of what the design of these policies is so you can make a better informed decision. When we're building our wealth warehouse and we're applying privatized banking, we want certainties and guarantees baked into our contract. That is because if we're leveraging outside of our cash value and the base is subject to change, we could end up in some troubled waters. But with whole life, there are certainties and guarantees baked into the actual contract of these policies. That is one of the reasons why people love these things so much. Versus when we're talking IUL, an IUL is going to be tied to the market and there's going to be caps and floors. So your cash value is going to go up and down based on the performance of the market. So yes, if we're just chasing rate of returns, an IUL could be better suited. But if you leverage capital out in a market downturn, you could find yourself in very troubled waters. Having an IUL and practicing privatized banking is kind of like building your warehouse on a foundation of quicksand. If your foundation, your cash value is subject to change and you're leveraging capital out, your house could crumble. And also when we're talking IULs here, there's way more potential for things to go south. IULs are going to pay a way higher commission and they're going to have later break-even points inside their policies too. Poor designs can really hurt folks a lot and even cause them to lose money. Also, IULs, although whole life isn't completely off the hook, they'll have captive companies that really focus on recruiting and sales. And predators will be inside these companies and they will prey on you to get a higher commission rate. So proceed with caution when you're jumping into the insurance space. So in conclusion, know your design. Don't get caught and match your beliefs with your design. This is an angle that I've been working through. Yes, there are a lot of predatory agents out there, but there also are a lot of good ones that are really trying to help you reach your why quicker. So you got to ask yourself, like, how are you making your living? I make my living getting people to reach their why quicker. There's opportunities for terrible things to happen, but if you find an agent who's in line with your values and understands what you're trying to do and when you're trying to get there, you guys can work together and create the proper policy design that is meant for you. The next topic that I want to talk about is what to do after you have your privatized banking system. And this is the number one question that I had when I had my first policy. I was like, okay, cool. I have this system. I have this foundation. I have this bank ready to go. Now, what do I do with it? So let's talk about the functions of insurance. This is my personal opinion. Insurance is really good at safety and having safe, boring investments. I use whole life as a bank and then have a separate arm for my investing aspects. Some insurance products try to do everything in-house. They'll have the investing arm with insurance under the same roof. And this ties into the whole life versus the IUL debate. IUL pairs investing with life insurance. But my argument here is why to cram everything under the same chassis. Your vehicle doesn't have to do everything. You could end up in a position when you're just doing everything okay instead of breaking the counterparts apart and then specializing. You could use whole life as the banking aspect and the insurance aspect, then have a separate investing arm to compound your growth. A great counter argument for the debate of IUL is just having proper design. And that may be true, but proper design is not the arm, and there's a tremendous amount of risk in setting these policies up. And a lot of folks come to the privatized banking world because they are disenfranchised with the traditional financial system. They want to get out of the market. They want certainties and guarantees baked into their actual wealth plan. But then with an IUL, we go right back to where we started. If I'm trying to get out of the market, why would I go back into the market with my investing arm of my wealth building plan? A lot of people go to insurance for stability and security. Then if they get tied up in an IUL, you are going back to where you sought shelter from in the first place. And applying this again to the wealth warehouse foundation concept that we talked about before, if we're applying privatized banking and we're extracting cash value and our cash value base is subject to change, i.e. the market, i.e. IUL, that could leave you in a very dangerous spot. Versus when we're looking at whole life, although the returns won't be as high, we have certainties and guarantees baked into that actual contract. And that is why banks are the largest owner of whole life policies. Getting back to this concept of what to do with your policy after you have it created and structured, that's really one of the questions that I set to answer when I created generational growth. I bridge the gap between having your policy and actually getting into different cash flowing assets. The right asset is going to be dependent on what you're trying to do and when, but you could access my network and get into those cash flowing assets quicker and save yourself a lot of time. So if you're in creative finance, land, I have a lot of different options for you to work with without going through all that networking hassle. And that ties into my overall system with generational growth. At top is my why, precision philanthropy. I have a lot of philanthropic goals inside the martial arts and disabled community. And there's really two sides to what I'm doing. On the first side, I free up capital with infinite banking. And then on the second side, I plug that freed up capital in using my network. And this ties into the overall generational growth cycle with our specific leverage systems. For what we're doing here, whole life insurance is one of the best and most optimal vehicles that we could apply for leverage. We take leverage out from that system, we generate cash flow, and then the cash flow pays off the interest that we take from our policy loans. Again, highlighting the second pillar here inside the generational growth cycle, you could save a lot of time and efficiency going through a network instead of going through all this hassle by yourself. So those are the main topics that I wish I would have known before I got started. And after this video, you could see how convoluted the nature is of insurance. There's so much going on. There's different durations, there's different products, there's different companies. Things can get very confusing. And this just goes into part of human nature too. We get very tribal in our beliefs and we get stuck in these echo chambers and we don't want to extract ourselves out of them because our egos get intertwined with those actual beliefs. It can be very difficult to step out and come in with an open mind to sift through a lot of this different noise. I met people in the industry that have been around for 10, 20, even 30 years, but they have no clue about how to apply these policies for the infinite banking concept. Some people could get so trapped inside the protection or the IUL or security spaces, they just straight up don't know what's going on because they get trapped inside their different pockets. But if you come in with an open mind, you lay out the facts, you do your own analysis and match the product with your end goal, then you could compound your generational growth in a much more efficient manner. These tools have been great for me and my family and it's taken me to a whole new level in terms of wealth building. I hope you enjoyed this video. If you have any questions on policy design, I offer a free policy review. And if you're looking for more training as well, check out the links in the description for some more training products.